Hello everyone, welcome back. In the last session, we covered ISA 200, the foundation of auditing. Now we are moving to ISA 210, the egging the terms of audit engagements. This standard is very practical. It tells us what the auditor must do before starting the audit, how to agree the terms, check if the preconditions are met, and what to do if management wants to change things midway. So basically, ISA 210 is about setting the rules of the game before we start playing. ISA 210 deals with the auditor's responsibilities when agreeing the terms of the audit engagement with management and, where appropriate, with those charged with governance. The objective is clear. The auditor should only accept or continue an audit engagement if the preconditions for an audit are present and there's a common understanding of the terms of the audit engagement. If these two are not in place, the auditor should not proceed. Now, what do we mean by preconditions? Preconditions are the minimum requirements that must exist before we can do an audit. They include the use of an acceptable financial reporting framework, management acknowledging and understanding their responsibilities. And what are management's responsibilities? Let's break that down. Number one is preparing the financial statements in accordance with the framework. And number two, maintaining internal controls necessary to support reliable financial reporting. And number three is providing auditors with access to information, additional explanations, and unrestricted access to the people in the organization. If management does not accept these responsibilities, the auditor cannot carry out a proper audit. Another important point, if management tries to impose a limitation on the scope of the audit at the start, like saying you cannot look at certain records, and if that limitation is so severe that it would force the auditor towards the disclaimer of opinion, then the auditor must not accept the engagement unless the law requires them to. This is very practical. Auditors cannot sign up for an audit where their hands are tied from day one. Now let's talk about agreeing the terms. The auditor must agree the terms with management or those charged with governance. Normally, this is recorded in an audit engagement letter. The letter must include the objective and scope of the audit, the auditor's responsibilities and management's responsibilities, and the applicable financial reporting framework, and also the expected form and content of the auditor's report, and a note that the report may sometimes differ from what is expected. This letter is critical because it avoids misunderstandings later. Um, for recurring audits, like when you audit the same client every year, ISA 210 says you should assess if circumstances require the terms to be revised. Even if nothing has changed, sometimes it's useful to remind management of their responsibilities. For example, you might send a short confirmation letter saying we are continuing under the same terms as agreed previously. Now, what if management wants to change the terms during the audit? ISA 210 says the auditor should not agree to a change unless there is a reasonable justification. For example, if management says instead of a full audit, can you just do a review? The auditor must check whether that's justified. If there is no valid reason, the auditor should refuse. If changes are agreed, they must be recorded in a new engagement letter. But if the auditor cannot agree and management insists, Then the auditor may need to withdraw and also consider if they must report the matter to regulators or those charged with governance. ISA 210 also has some special situations when laws or regulations prescribe the reporting framework. Sometimes the law requires the use of a framework that the auditor might normally find unacceptable. In that case, the auditor can still accept the engagement if management agrees to provide additional disclosures, and the auditor emphasizes this in the report. When the auditor's report wording is prescribed by law, if the required wording is significantly different from ISAs, the auditor must check whether users might be misled. If yes, the auditor should add explanations. If the misunderstanding cannot be avoided, then the auditor should not accept the engagement unless required by law. So you can see how ISA 210 balances professional requirements. The appendix of ISA 210 even provides an example of an audit engagement letter. Typically, it starts with we are pleased to confirm our acceptance and our understanding of this engagement, and then sets out all the points we discussed. The letter is signed by the auditor and acknowledged by management. In practice, firms often use templates, but they adapt them to each client's situation. Let me give you a practical scenario. Suppose you are approached by a new client, a medium sized manufacturing company. You ask, what framework do you use? They say, we prepare under IFRS. That's acceptable. Then you ask management to acknowledge their responsibilities, preparing the statements, internal controls, giving access. If they hesitate and say, we don't want to give you access to supplier contracts, that's a red flag. Without that, you cannot perform a proper audit. So, under ISA 210, you should decline the engagement. On the other hand, if they agree, you draft an engagement letter covering scope, responsibilities, reporting, and fee basis. Once signed, you can start the audit. All right, let's recap ISA 210. The auditor must check that preconditions are met before accepting an audit. And preconditions include an acceptable framework and management acknowledging their responsibilities. And engagement terms must be formally agreed, usually through an engagement letter. Scope limitations that would force a disclaimer of opinion mean you should not accept the job. For recurring audits, reassess whether terms need updating. If management requests changes, only agree if justified and document them. And special rules apply if the framework or report is prescribed by law. So, in short, ISA 210 ensures that everyone, the auditor, management, and governance, is on the same page before the audit begins. And that's why it's such an important standard. It prevents disputes later and protects the auditor's independence. Thank you for listening.